The rule change nobody read. It was passed quietly, buried inside dense language, technical references, and procedural updates that few outside regulatory circles ever bothered to examine. Yet this single rule change altered how risk was counted, priced, and ultimately ignored across the American banking system in ways that would take years to fully surface. No protests followed it. No headlines explained it. No public debate ever questioned its consequences. And because almost nobody read it closely, its impact unfolded without resistance. To understand why modern banking risk often appears misaligned with reality, we need to return to this moment of administrative certainty, when policymakers believed refinement meant safety and complexity meant precision, because the logic behind that belief still governs how danger is measured today. The rule did not announce itself as transformational. It was framed as clarification, as harmonization, as technical alignment with evolving financial practice, language designed to reassure rather than alarm. Its purpose was simple on paper: update how banks calculate risk, refine capital treatment, modernize assumptions to reflect sophisticated markets. But simplicity on paper rarely survives contact with incentives. By adjusting how assets were weighted, modeled, and categorized, the rule quietly changed what banks were encouraged to hold, how they structure exposure, and where they search for returns, all without requiring them to take visibly larger risks. Certain assets suddenly appeared safer. Others became less attractive. Risk did not vanish. It shifted, reshaped by definitions rather than behavior. Banks responded quickly, not because they wanted to exploit loopholes, but because survival inside regulatory frameworks requires optimization. Capital efficiency became strategy. Balance sheets evolved to reflect what rules rewarded. What made this shift especially dangerous was its invisibility. From the outside, banks appeared stronger. Capital ratios improved. Reported risk declined. Compliance looked exemplary. But those improvements reflected arithmetic, not resilience. They reflected how risk was labeled, not how behaved under stress. The rule measured exposure more precisely, but understood it less completely. Most observers never questioned the change. The language was dense. The math was technical. The outcomes appeared positive. And so the system moved forward, confident it had refined itself, unaware it had just rewritten the map it used to navigate danger. That was the quiet power of the rule. It did not force banks to take risk. It made certain risks feel permissible. And once risk feels permissible, it rarely remains small. Once the rule took effect, its influence spread gradually but decisively, reshaping behavior not through direct instruction, but through incentives that quietly guided banks toward the new framework defined as efficient, acceptable, and strategically optimal within the boundaries of compliance. Risk departments recalibrated their models to reflect the updated calculations, not questioning the assumptions embedded within them, but trusting that regulatory precision implied safety, and that alignment with the rules meant alignment with reality. Even as those two ideas slowly drifted apart, assets that consumed less capital became more attractive, not because they were inherently safer, but because they appeared safer under the new measurement system, encouraging banks to increase exposure while maintaining the appearance of prudence and discipline on paper. This did not look like excess. It looked like optimization. Balance sheets became cleaner. Ratios improved. Reported resilience strengthened. But beneath those improvements, concentration was increasing. The same assets appeared across institutions. The same strategies spread quietly. The same definitions shaped decision-making everywhere. What the rule unintentionally encouraged was convergence. Different banks, with different cultures and histories, began responding to risk in similar ways because they were all reading from the same regulatory map, one that emphasized calculated precision over behavioral uncertainty. As portfolios aligned, diversity declined. Risk became less dispersed. Exposure clustered around what the rules favored most. And because each institution complied individually, no single balance sheet raised concern. From a supervisory perspective, everything looked orderly. Capital cushions appeared robust. Stress scenarios passed. Compliance metrics improved year after year. Yet the rule had narrowed the system's field of vision. It measured risk as static categories rather than dynamic behavior. It captured what assets were, but not how they would react together under pressure. Banks internalized these assumptions deeply. Strategic planning optimized for regulatory treatment. Innovation followed capital efficiency rather than economic resilience. Judgment adapted to arithmetic. The danger was not that banks ignored risk. It was that they trusted its measurement too completely. They believed the map was accurate because it was detailed. But detail is not the same as completeness, and precision is not the same as understanding. As a result, the system grew confident in numbers that describe compliance, while becoming increasingly blind to interactions that only appeared during stress. The rule had succeeded at what it set out to do. It refined measurement. It standardized assessment. It improved consistency. What it did not do was prevent risk from accumulating in new, less visible forms, waiting for conditions that would force those hidden correlations into the open. The conflict emerged when reality began pressing against the assumptions embedded inside the rule, revealing that risk measured cleanly on paper does not behave cleanly when markets move, confidence shifts, and behavior aligns faster than models can adjust. As conditions tightened, assets that had been treated as low risk began reacting in unison, not because they shared the same fundamentals, but because they shared the same regulatory logic, the same capital treatment, and the same presence across balance sheets that had quietly converged over time. Banks responded exactly as the framework encouraged them to. They adjusted positions. They rebalanced exposure. They trusted the numbers. But those numbers were backward-looking. They reflected historical calm. They assumed independence where correlation was forming. They measured size, not speed. What made the situation unstable was not a sudden surge in recklessness, but the absence of friction. When pressure appeared, many institutions moved at once, guided by identical signals and identical incentives, turning what should have been isolated adjustments into synchronized reactions. Liquidity behaved differently than expected. Markets hesitated where models assumed flow. Prices moved faster than capital buffers could compensate, and risk that seemed diversified revealed itself as tightly linked. Supervisors saw stress rising in places that had always looked safe, not because rules were violated, but because rules had shaped behavior too precisely. The system was compliant, yet unstable. Interventions followed. Facilities expanded. Requirements were adjusted. Reassurance was delivered, but each response exposed the same uncomfortable truth. The rule had not reduced risk. It had concentrated it. By encouraging similar balance sheet structures, it ensured that stress would travel efficiently once it began. Banks realized that protection now depended less on understanding exposure and more on how quickly support would arrive. Planning shifted accordingly. Risk tolerance recalibrated around expected response. This created a self-reinforcing loop. The more the system relied on intervention, the more behavior adapted to require it, and the more behavior adapted, the less meaningful the original measurements became. The conflict was no longer about compliance. It was about whether precision had replaced judgment, whether rules had become substitutes for understanding, and whether a system optimized for measurement could still respond to uncertainty when measurement failed. By the time these questions surfaced clearly, the structure they described was already deeply embedded. The climax arrived not as a sudden breakdown, but as a slow, unsettling recognition spreading through institutions, regulators, and markets that the system had become exceptionally good at measuring risk, while growing increasingly poor at understanding how that risk would behave once conditions stopped cooperating. The rule had delivered exactly what it promised. Capital ratios looked stronger. Compliance was cleaner. Balance sheets appeared safer by every formal definition that mattered. Yet when pressure tested those definitions, they offered clarity without protection. What failed was not mathematics. It was interpretation. Risk had been reduced to categories, weights, and coefficients that assumed independence, stability, and orderly behavior, even as real-world markets proved repeatedly that behavior under stress is emotional, collective, and nonlinear. By optimizing for precision, the system had narrowed its vision. By trusting refined measurement, it had discounted uncertainty. By standardizing judgment, it had synchronized behavior. When stress arrived, assets behaved less like independent exposures and more like a single structure moving under pressure. Losses did not spread randomly. They followed the pathways the rule had quietly encouraged. Concentration revealed itself only when it mattered most. Intervention restored calm once again. Support arrived. Market stabilized. Confidence returned. But the lesson remained unresolved. Rules can shape behavior as powerfully as incentives. Measurement can change reality rather than describe it. And precision, when mistaken for understanding, can become a source of fragility. The resolution is not about abandoning regulation. Rules are essential, but rules must remain humble. They must leave room for judgment, diversity, and uncertainty. They must recognize that what cannot be measured precisely still matters deeply. American banking continues to operate inside the shadow of that unread rule. Risk is still calculated with confidence. Compliance still signals safety. And complexity still hides correlation until it's too late. The most dangerous rules are not the ones that fail. They are the ones that succeed so completely that no one notices what they quietly encourage. Sometimes the smallest shift in perspective becomes the beginning of a new future. The rule